Hello and welcome. You're watching Business Plus, the afternoon edition here on News9 Live. I'm Krishnakumar and I'm being joined by my colleague and friend Suyash Maheshwari in the studio. And as always, we begin this afternoon edition of Business Plus with a check on how Indian stock markets fared for today's trading session. Indian stock markets, Sensex and the Nifty off to a decent start. But then towards the last couple of hours of the session, falling deeper and deeper into the red. Wasn't that the case, Suyash?
Exactly, Krishna. Now, after a flattish opening, Indian markets succumbed to selling pressure, but the big fall, Krishna, came nearly about in the last last hour of trade or so, just as the 10-year treasury yields hit 5%, which was a level last seen in 2007, just before the credit crisis in 2008.
So you mean the US treasury yields?
The US 10-year treasury yields have hit a 16-year high of 5%. Now, why is it such a big deal? I think we should explain that. The 10-year yields is a key barometer for mortgage loans, auto loans, student loans. So when the bond yields rise, it can significantly impact the borrowing cost for businesses, consumers, as well as the government. Now, second is that generally the spike in bond yields make the government debt more appealing compared to stocks, as investors factor in a higher cost of doing business by companies. And apart from the 10-year treasury yields, of course, there is the conflict that is going on in the Middle East, which unfortunately is far from over. And I mean, Krishna, now it's not only a humanitarian crisis, but it's also turning into a financial crisis, since the entire Middle East region, where the war is expected to spread, at least how things are looking, is responsible for nearly 1/3 of the entire world's oil production. And talking about oil now, Brent crude over the weekend has softened slightly, but it is still hovering at an uncomfortable level for us, which is around the $92–93, especially for India, because we are net importers of oil.
All right. So those are the factors that impacted the cause for the crack in the market in the afternoon session of trade. We also have Mr. Rohit Srivastava, founder, Money Analytics and Indiacharts, also joining us. Rohit, thank you so much for taking time out to be with us. We'll just come to you. Suyash, also tell us, it's a day in which Sensex and Nifty both have lost nearly 1.5% in the red, and you're seeing that red falling into mid-cap and small-cap indices as well. Talk to us about them and, of course, the big sectors that were hit in today's trading session.
Certainly, Krishna. So, the last tick for Nifty came in at around 19,281 mark, which is down about 1.34% for the session. Now, this is the lowest level since August end, and with today's close, Nifty has extended its losing streak to now about four sessions. Sensex, on the other hand, fell nearly 825 points and closed below the 64,600 mark. Now look at the advanced decline ratio, Krishna. I mean, about 457 shares advanced for every 2,893 shares that declined, which means that nearly almost 6 stocks fell for every one that rose. So the overall breadth of the market has also deteriorated quite significantly. Now the broader markets, Krishna, the bloodbath continued over there. Nifty mid-cap 100 corrected by over 2.5% and fell to a 2-month low. Nifty small-cap 100, on the other hand, was worse off. It was down about 3.5%. Volatility also saw a spike of about 0.8%, with India VIX closing in at 10.91%. Now, among sectors, Krishna, it was a sea of red. Nifty media was a worst hit. The sector was down about 5%. The metal pack was also down by about 3.26%. The PSU banking pack, Krishna, despite the early resilience that we were seeing in the banking pack, Nifty PSU ended today's session down about 3.77%. Talking about banking pack, Nifty Bank, which was pretty much hugging that trend line for the majority of the session, also saw a sharp decline in the last hour of trade and closed down 1.3% at 43,151 levels. I mean, the only sector, Krishna, that I can see that did not fall 1% was Nifty FMCG, which corrected by 0.8%. I mean, on any other day,
they're not called defensives for nothing. Even in this market, you see that Nifty FMCG pack falling the least. And that's why, ladies and gentlemen, the traditional conventional wisdom is that you put money in FMCG stocks and defensives, you lose less on a day in which you see others bleed. Look at Nifty Media, PSU Bank, Nifty Realty, Nifty Metal, all down anywhere between 2.5% to 5%. Incredible a sea of red over there. This takes to Rohit Srivastava, founder Strike Money Analytics and India Charts. Rohit, what a day of trading it's been. Not many expected this kind of an ending. And how much are you spooked by that 16-year high of US 10-year treasury bond yields hitting after 2007?
So those are multiple questions. One thing is to be spooked and one thing is to be prepared.
Okay.
But we got spooked, I think, in the last 2 weeks itself, and more so in the last week, because just remember that just last week the small cap index actually hit an all-time high, but it was not confirmed by the mid cap index. Simultaneously, the US VIX actually shot up to 21%, so that was a multi-month high. And as you've already mentioned, bond yields again continue to move higher without any intervention from the Fed, which means that even though they're oversold, they're continuing to give us a signal that something's not right in the bond market. But I'll tell you, apart from all of this, what is really worrying right now, at some point of time, we would have thought that weakening inflation data could have caused the bond market to bounce back, and then markets could have eased a bit. What is happening though is that because the Fed is staying on the course of higher for longer interest rates, it is actually beginning to slow down the US economy. Now, where do you really look for a recession signal? You look at it at something known as the yield curve, which is the difference between the 2-year and 10-year bond yields. And that difference between the 2-year and 10-year for almost a year has been inverted. Now, the inverted yield curve tells you that you're getting into a tight situation, but it doesn't really predict the recession itself. So most of the recessions actually happen after the yield curve starts to steepen and specifically go above the zero mark. Now that has started to happen over the last 2 months. The steepening has started, and that is what is spooking the US stock market right now, and has actually tipped it over to a point where you would really take all your bets off that market. Now, what that really means is that if the yield curve is signaling a potential US recession coming in the next couple of months, and or maybe over the period of time, markets will start pricing that in much sooner. And I think that is what has started. So that process has spooked first US markets, and I think finally it has spooked the Indian market, which was still trying to hit new highs, but now we are beginning to see that unwind. So I think people should be worried, because unless you can really get out of this, the downside risk increases significantly, because a US recession can really mean that the S&P topples more than 20%, which is a very significant number. If that event really happens, and then are you really prepared in terms of your portfolio positioning to handle an event of that kind, and what would be the impact of a 20% US market decline on the Indian markets, then becomes the next big question that we have to try and answer.
Now, Mr. Srivastava, Fed Chair Jerome Powell is due to speak, again on October 26. Now, in his last speech, he sounded rather dovish, talking about the strength of the US economy. However, without saying it outright, Mr. Powell also said that, the focus will be on bringing back the inflation to the long-term target of 2%. Now, I have two questions over here. Can the Fed really afford to, go for another hike, given that the interest rates, the 10-year treasury yields have climbed to a 16-year high? The second is that 2% inflation target even realistic in this economy?
So understand, the Fed funds rate is already above 5%. So all that has happened is bond yields have just caught up with the Fed funds rate. Now there's a very old theory that the Fed follows the bond market, and right now it looks like the bond market has been behind the Fed. So if the bond market actually started to signal lower rates, you would have seen the Fed starting to cut as well. But that has not happened. So in that sense, what will end up happening here is, if the yield in the market and the Fed funds rates are at the same level, they might actually end up doing nothing, which is sort of what he said in his last speech very, very recently, that they would probably just leave rates where they are, and leave probably one future hike on the table, which means they may not raise rates at this moment, but they'll not remove the possibility of raising it just in case. Right? So that doesn't really change the main point which he said, which is leaving rates higher for longer, which is if you keep interest rates at a very high level for a prolonged period of time, even though you may not be cutting them, you're not really stimulating the economy. And so what it does, it does hurt future demand. And in that sense, it will lead to a slowing down of the economy.
So then what's the way out for Fed? I mean, from your words, it looks like Fed is in a bit of a soup here.
One way or the other, damn it if you do and damn it if you don't.
Yeah, they have gotten themselves into a corner, that is for sure. And we would have hoped that they would see that, because the US does have a very large borrowing program, and the bet that the market was trying to take, why the markets were elevated despite rates moving higher through the early part of 2023, was that the markets were betting that at some point of time, if inflation comes down, the Fed will back off from its rate hiking program, because it has to fund the treasury that's going to borrow trillions of dollars to fund the government. So it's a circular trade, and if that has to happen, how are they going to do it? And so the market was betting on that, but it doesn't look like the Fed wants to give in till it has enough reason to do so, which means you need a crisis. You always need a crisis for them to really change their mind. And you don't have one yet. The last one was the banking crisis in March, and they did put a backstop to that. And now we are simply waiting for the next one to show up. So till the time the next one shows up, if they don't back up on yields, they end up slowing down the economy.
Now that you're talking about crisis, there are many, from the likes of Robert Kiyosaki to even Ray Dalio, who are talking about an impending crisis or an impending crash, except that we could be possibly better prepared this time around as compared to 2008. The only reason why I'm asking this question is because that year is ominous. We're talking about it on a day in which US 10-year treasury yields have hit the levels they've hit in 2007. We all know what happened in 2008. So my question, and there are talks of an impending crisis/crash happening in the US. I want your thoughts on that. At a time when the high interest rate cycle looks like it's going to continue forever.
Yeah, so it may not continue forever, but for the time being, you're right, the rates have reached similar levels. The reason they haven't caused the same calamity yet, now that is the first question to ask, is because a lot of loans, especially housing loans, were actually refinanced by retail at large when rates had really fallen to 2-3%. So a lot of the housing loans have been refinanced at those very low rates, which is why these high interest rates are not really leading to delinquencies or bankruptcies like they did in the housing bubble. So that's one thing which got taken care of. On the corporate side, similarly, a lot of corporates also reduced their debt levels. So these issues are not propping up. The real problem is now with the bond market itself, that if yields remain high and the bond market is falling, who's the largest holder of bonds? And it ends up being banks. And the banks are the ones that have taken the biggest hit. You can see the US banking sector being one of the biggest underperformers at this moment of time. And that pressure remains. So some segments of the market will get hurt by these high rates.
Now, Mr. Srivastava, what sort of a spillover effect can we see from the correction in the global markets, in Indian markets? If you can, give us some guidance in percentage terms.
So, in fact, I was actually surprised that in the recent RBI meet, the RBI actually talked about selling bonds. Now, Indian bond yields were actually not rising since June of 2022 when they touched around 7.6%. So that's more than a year that bond yields were actually down, and which was really helping the market conditions and also creating hope that yields in India will actually head much lower, which was also my expectation. But this has come as a surprise, wherein bond yields then have started to rise in India as well. Now, why did this happen needs to be questioned. It also creates some question mark around, is this a risk, currency risk management, step that they have really taken. Now, coming back to a number, see, we can start by being conservative, saying, fine, this will blow over, the Fed has to change its policy. If that is the case, then we'll have a minimum normalized correction down to maybe 18,800, 18,100 as a worst case scenario, which is around, say, 61% retracement of the entire rally that we've seen from the March bottom. So 18,100 could be that worst case scenario in a normal condition, which means, we don't get into a recession. They take some steps to backstop it, and, we're back to normal. But the risk, like I said, is on the table. The yield curve is pricing in the potential that a recession is coming. And if that is the case, and you have to really prepare for that, then you should be prepared to see much lower levels. Who knows, a retest of the March lows of 16,800 is something that we should mentally start preparing for. Whether it happens or not, of course, depends on the events. But since we've actually had a very good rally in the market, it's good to really at least get rid of things like excessive leverage, speculative stocks that people own. That's where you get killed the most, when you get these kind of reactions like you're seeing in the mid and small caps today, and that you need to really protect yourself from and move away from.
All right. We have multiple questions in our heads that popped up. Both me and Suyash. Suyash, let me just begin, and then you can of course continue. One is, did you just say we could be back to March 2023 levels? We are in October. If we are going to be back to March 2023 levels, when are you expecting this to happen? Is my first thoughts. How soon do you expect this to happen? Before we end with the calendar year or the financial year, or which one are you talking about? And Suyash, you had some questions in mind as well.
Yeah, I mean, if you're factoring in a 6 to 10% correction, I mean, would it be prudent to really book those profits, as you were saying, from speculative bets? Like this broader market, the kind of run-up that we have seen, I mean, will it be prudent to book those profits from the broader markets at this point?
I think some level of de-risking. See, I'm not saying that we will go to back to the March lows. The question was that if the US heads into a recession, then that becomes a possibility. The problem is that we are often unprepared. There are two approaches one can have. One can say that, okay, I'm sure this won't happen, and therefore I will not take these actions. The second one is that you see a possibility of something, and then you prepare accordingly. See, I can sell something today. I can always buy it back if it goes down to only 18,000 and it looks like the world is normal. You're not going to get a recession. Things are not going to slow down, and fine. We are all good. The problem is that if you try to decide after it breaks 18,000 that, oh my God, we are getting into trouble now, shall I sell? My understanding is that most people would be unable to do so emotionally and psychologically. It's not that you can't pull the trigger, but most people cannot, because they're not really trained to really handle markets that way. We're just trained to save, invest. We are working somewhere. We're not financial market experts or professional traders who can, get in and get out at the drop of a hat. So which is why it actually makes sense for a lot of people to book gains to some extent. Everybody can decide what extent that is. Should it be 20% of your portfolio, 30% of your portfolio? But if you create some degree of cash in a good market at good levels, then it definitely gives you the room to maneuver when things are much lower. Not only to re-enter if that is a possibility, and also if you feel later that, okay, I need to cut further, it will be much easier for you because you've already done it once at a higher level and reduced your downside risk. So I think some kind of action is definitely called for, without really saying, when this happens, because, recession can be 3 months. See, markets can fall much faster than the event itself. As the market starts pricing in the possibility, it will start dropping month after month. December is a seasonal period where sometimes markets can be at a peak or a bottom. So it's a good point to think that we may complete some kind of a minimum worst case scenario we may end up seeing by December, whatever that number is. So maybe December is a good place to even review whether the worst is over at that point of time.
So given the kind of uncertainties that we have talked about in nearly the last 20 minutes, what would be your advice to the retail investors? How should they navigate the market at this point in time?
So I'll end up repeating a bit of what I said. First is deleverage. I don't know how leveraged each one is. Some people do borrow money and buy stocks. So leverage is something that you should seriously reduce, because that's what gets into trouble immediately, because it causes double X drawdowns when markets start to decline. The second is one place where I have significantly reduced exposure is newly listed companies, IPO'd ones, because they've not really been through a bear market, sometimes do take a hit, and they don't have enough history at the beginning. So any stock that has been, not listed for more than a year or two is something where I would, and if there have been gains, I would actually book out and think about it later. So these are the kind of steps that one can actually think about. But broadly, creating some level of cash, 20%, 30%, usually mutual funds don't build more than 5-10% cash levels, but portfolio managers and PMSs do sometimes go up to 20-30%. And that's what individuals can actually do, because they're not restricted by any rules or guidelines, that create some level of cash that makes you comfortable, that if there is a market dip, one, you have ability to re-enter at that point of time, so you have cash to deploy, and you're also able to decide whether things are going to get worse and you need to take further action. So I think start by actually creating some level of cash based on your own risk profile.
Start by creating cash is the word coming from Mr. Rohit Srivastava, founder of Strike Money Analytics and India Charts. I'm going to thank Mr. Rohit Srivastava at this stage. Thank you so much for taking time out to be with us here on Business Plus on News9 Live and helping put the carnage for the day into perspective. Hope to keep having you again and again on the show. But for now, we'll let you go. Thank you so much. And thank you, Suyash, for taking time out to, of course, put the markets in perspective as you do every single day.